Hello, and welcome back to the Financial Podcast. I'm your host, Olivia, and today we're diving deep into the recent developments surrounding Constellation Energy Corporation, or CEG, a company that has been making significant waves in the energy sector. We'll explore their financial performance, strategic decisions, and how these are shaping their future trajectory, drawing insights from various recent reports. Constellation Energy has recently been a hot topic of discussion, particularly on platforms like X, where many users have highlighted the company's impressive Q1 earnings. This strong financial showing, coupled with broader market enthusiasm and positive analyst updates, has fueled a significant boost in CEG stock performance over the past month. In fact, reports indicate that Constellation Energy stock soared by 7.42% during pre-market trading on June 3, 2025, signaling a robust start to the trading day. Furthermore, it was identified as the second best performing stock on the S&P 500 in May, spiking approximately 37%, and was also the third best stock on the Nasdaq composite during the same period. This remarkable performance was partly attributed to their solid Q1 earnings report and outlook, but also received a significant lift from an executive order by the Trump administration that called for the acceleration of nuclear energy. As the leading provider of nuclear energy in the U.S., this policy direction clearly benefited Constellation Energy. One of the most critical strategic updates for Constellation Energy involves a decision by the U.S. Department of Energy, or DOE, to allow a key 760-megawatt energy production facility to continue operations. Specifically, the DOE mandated extended operations for Constellation Energy's 760-megawatt oil and gas-fired power plants in Pennsylvania, initially slated for closure, to remain functional at least until August 28th. This directive underscores the pressing need to maintain electricity reliability, especially during the peak summer months when demand surges, ensuring communities have consistent power. The DOE's emergency order, issued on June 2, 2025, targeted 2 units at Constellation's Edstone power plant near Philadelphia, directing their operation until August 28th with the possibility of extension. This action was partly based on a PJM interconnection warning about potential needs for demand response resources under extreme conditions this summer to prevent power outages. PJM, which operates the grid and wholesale power markets across 13 Mid-Atlantic and Midwest states and the District of Columbia, supports the DOE's order as a prudent term-limited step to retain these generators for 90 days, allowing for further analysis on their longer-term necessity and viability. The DOE's use of the Federal Power Act's Section 202C to temporarily order power plants to operate during emergencies is notable, having been used 17 times since August 2020. This recent intervention for Constellation Energy's Edstone plant, along with a similar order for a coal-fired plant in Michigan, signifies a bold escalation in federal policy. This regulatory hammer effectively declares war on prior retirement schedules, especially in the context of PJM's projected capacity shortfall of 10 gigawatts by 2026-2027. The message is clear. Retirements will be delayed, and dispatchable assets such as natural gas/oil peaker plants and nuclear facilities are now deemed critical infrastructure. Constellation, as the owner of Edstone, is taking immediate steps to ensure Units 3 and 4 remain operational through the summer, including retaining necessary staff and performing maintenance. It's worth noting that PJM had initially approved Constellation's request to shut down these units in February 2024, stating there were no reliability risks, but the DOE's order overrides this. Critics, including Earth Justice and Public Citizen, have raised concerns about the implications of not retiring the Edstone units on Constellation's proposed $16.4 billion deal to buy Calpine, as well as the potential for increased electricity costs to ratepayers due to deferred maintenance and operational expenses for these older units. This situation highlights a critical policy pivot, where short-term grid stability now often trumps long-term retirement schedules. Beyond regulatory directives, Constellation Energy has also secured a groundbreaking partnership with Meta Platforms, Inc., the parent company of Facebook, Instagram, and WhatsApp, Meta has signed a 20-year agreement to buy nuclear power from Constellation Energy. This significant deal involves Meta purchasing approximately 1.1 gigawatts of power from Constellation's Clinton Clean Energy Center in Illinois, beginning in June 2027. This is the entire output from the site's single nuclear reactor. This long-term agreement is crucial as it will support the continued operation of the Clinton plant and its relicensing, as the plant was at risk of premature closure once its zero-emission credit, which it relied on since 2017, expired. Constellation's president and CEO, Joe Dominguez, emphasized the importance of this partnership, noting that supporting existing plants is as impactful as finding new energy sources. While the specific financial terms of the deal were not disclosed, it will also expand Clinton's output by 30 megawatts. It's important to understand that the Clinton plant will not directly power Meta's data centers. Instead, it will continue to provide power to the regional grid, contributing to Meta's goal of achieving 100% clean electricity. Constellation shares rallied more than 15% following this announcement. This deal marks Meta's first official venture into nuclear power, driven by the voracious appetite for energy to run their data centers and support their artificial intelligence ambitions. This trend isn't isolated. It's part of a broader wave of tech giants teaming up with the nuclear industry. For instance, Constellation previously announced in September that it would restart 3 Mile Island and sell power to Microsoft under a 20-year agreement. Other tech companies like Google have pledged to fund new nuclear sites and partnered with small modular reactor SMR developers, while Amazon has invested in SMR development and acquired data centers powered by nuclear plants. These companies, including Amazon, Google, and Meta, even signed a pledge in March led by the World Nuclear Association advocating for a tripling of nuclear energy worldwide by 2050. This growing demand from data centers, coupled with federal backing, is repositioning nuclear assets as critical for baseload reliability. Constellation itself is considering seeking a new permit from the Nuclear Regulatory Commission to potentially build a small modular reactor at the Clinton site. This highlights how nuclear energy is no longer seen as a dinosaur, but rather a crucial component in bridging the timing mismatch between retiring thermal plants and the slower deployment of renewables. From an investment perspective, Wall Street analysts have shown a positive outlook on Constellation Energy. 4 firms have issued buy ratings on the stock, with 0 sell ratings. Recent ratings include a buy from UBS on May 5, 2025, and overweight or outperform ratings from Wells Fargo, Guggenheim, and Evercore ISI earlier in the year. The consensus rating among analysts is indeed a buy, with an average price target of $291.54, reflecting optimism about the company's future performance and growth potential. 2 analysts have offered price targets for CEG in the last 6 months, with a median target of $289. While this median target might suggest a potential downside from current trading levels, other forecasts range significantly, with the highest estimate at $385. Overall, the average target from 13 analysts is $294.67, implying a potential downside of 5.78% from its current trading price of $312.75. However, analysts also expect the stock to rise by 44.77% over the next 3 months, with a 90% probability of holding a price between $336 and higher. Despite recent volatility, Constellation Energy has demonstrated stability in its share price over the past 3 months compared to the broader U.S. market, with relatively low weekly volatility indicating steady performance. Guru Focus's valuation metrics, however, present a contrasting view, estimating the GF value for CEG at $106.54 for the coming year, which points to a significant downside of 65.93% from the current market price based on historical trading multiples, past growth, and anticipated future performance. This divergence in valuation highlights the varied perspectives on the stock. Looking at trading activity, members of Congress have traded CEG stock 5 times in the past 6 months, with 3 purchases and 2 sales. Notably, Representative Julie Johnson made one purchase and one sale, each worth up to $15,000. Representative Jefferson Shreve sold up to $50,000, and Senator Shelley Moore Capito made two purchases totaling up to $30,000. In terms of insider trading, Constellation Energy insiders have traded CEG stock twice in the past 6 months, both sales. Matthew N. Bauer, the SVP and controller, made two sales, selling 4,000 shares for an estimated $1,241,580. This insider selling might be something to keep an eye on, though it's important to consider context beyond these numbers alone. Institutional investors, including hedge funds, have also been actively adjusting their positions in Constellation Energy stock. We've observed 822 institutional investors adding CEG shares to their portfolios, while 738 decreased their positions in the most recent quarter. Some of the largest recent moves include Jennison Associates LLC, adding over 3.4 million shares, increasing their portfolio by 428.6% for an estimated value of over $695 million. Wells Fargo and Company/MN also significantly increased their holdings, adding over 2.2 million shares. Conversely, Lone Pine Capital LLC removed all of their 1.7 million of their shares, and D.E. Shaw & Co. Inc. removed over 1.6 million shares. This mix of significant additions and removals highlights diverse institutional strategies and perspectives on Constellation Energy's future. The broader narrative for Constellation Energy is deeply tied to the evolving energy landscape. The energy transition isn't a simple shift to renewables. It's a complex path where grid stability often demands dirtier fuels and atomic power in the short to medium term. Federal regulators, through emergency orders and strategic initiatives, are increasingly keen on preserving dispatchable assets due to concerns about capacity shortfalls and reliability. The DOE's upcoming methodology to identify critical resources by July 7th will likely further solidify the role of these assets as grid pillars for years to come. This regulatory tailwind, combined with rising capacity prices in markets like PJM, creates a favorable environment for utilities with dispatchable portfolios, including Constellation Energy. In conclusion, Constellation Energy is at a pivotal moment, benefiting from strong financial performance, a strategic partnership with Meta driven by the growing demand for clean energy in AI and data centers, and crucial government interventions aimed at ensuring grid stability. While analyst opinions vary on future price targets, the general consensus reflects optimism, and significant institutional activity points to ongoing investor interest. The company's unique position as a leading nuclear energy provider, coupled with the renewed focus on dispatchable assets for grid reliability, positions CEG as a compelling entity to watch in the evolving energy sector. Thank you for joining me today on the Financial Podcast. We hope this deep dive into Constellation Energy has provided you with valuable insights. Be sure to subscribe so you don't miss our next episode. Until then, stay informed and make smart financial decisions. Goodbye for now.